Affirmative allocation is how you take control of your generation skipping transfer tax exemption. Instead of relying on automatic rules, you or your executor explicitly apply GST exemption to a specific transfer or trust on a tax return, Form 709 for lifetime gifts or Form 706 at death. You name the trust, the date, the value, and the exact exemption amount. Why do it? Certainty and control. You can lock in a 0% inclusion ratio for a dynasty trust by covering the value at funding. You also avoid misfires where automatic rules over-allocate to short-term trusts or under-allocate to multi-generational vehicles. And because GST exemption isn't portable, spouses must coordinate intentionally, often alongside a reverse Q-tip election. Mechanics are simple. Identify the transfer, state the exemption, and create the applicable fraction, which is exemption divided by value. Inclusion ratio equals 1 minus that fraction. Fully cover the value and the inclusion ratio is 0. Timing matters. Allocate at funding to use less exemption. Late allocation is allowed, but it uses the later, often higher value. During an estate tax inclusion period, such as a GRAT or QPERT, your allocation waits until ETIP ends and is measured then. Here's a quick example. Gift $3 million to a dynasty trust and allocate $3 million of GST exemption on a timely Form 709. The inclusion ratio will be 0 and future GST events occur without GST tax. Elect out for short-term spend-down trusts and keep precise records. For more on estate planning and wealth management, visit 49thparallelwealthmanagement.com or pick up a copy of my book, Crossing the 49th Parallel, a retirement planning guide for moving across the Canada-US border. It's available everywhere books are sold. From the desert to the tundra, we are your cross-border retirement experts.